Good afternoon, everyone. The Department of Commerce, Economics and BBA of Cooch Behar College jointly organized 2-day special lecture series on today and tomorrow. Today, our resource person, Professor Dr. Gangotri Ghosh from University of North Bengal will speak on planning and management of taxes for individuals. I, on behalf of Cooch Behar College, welcome Professor Dr. Gangotri Ghosh in this online platform. Now I invite Professor Obi.
I think he is having some network issue. So, on behalf of Cooch Behar College and Department of Commerce, I welcome again.
Pramojit, may I proceed?
Please.
Actually, একটা ফোন এসেছিল তাই বেরিয়ে গেছিলাম। I, on behalf of Cooch Behar College, welcome Professor Dr. Gangotri Ghosh in this online platform. Now I invite Professor Abhijit Roy, Departmental Head of Commerce, to introduce our speaker and say a few words on this lecture series.
Thank you, Professor Monima Chakraborty, and on behalf of Department of Commerce, Cooch Behar College, I welcome our special guest speaker, Professor Dr. Gangotri Ghosh, Department of Commerce, University of North Bengal, for accepting our invitation to deliver her lecture on the subject related to personal income tax, planning and management of taxes for individuals. Also, on behalf of the department and all jointly organizing this special lecture series for 2 days, jointly with the Department of Economics, Cooch Behar College, and Department of BBA, Cooch Behar College. On behalf of all, I am welcoming Dr. Ghosh to deliver her lecture. This program has been organized for the benefit of the students in particular, because this topic is very much within their syllabus, ambit of their syllabus, and also to enrich our knowledge base in the whole field of this relevant area regarding our studies. Our principal sir also agreed to join this special lecture series, but due to some family problem, he has intimated me that presently he is out of the set, and that's why he will not be able to join at present. Anyway, I welcome Dr. Ghosh again for delivering her lecture. Thank you.
Thank you, Munimoida. Also, thanks to Tomojit. Honorable Principal Dr. Pankaj Devnath sir.
Madam, I am interrupting you. Madam, before starting, I have to say something to our students. Sorry for this.
Okay, it's not nice.
Okay. Before starting this lecture session, I want to inform my students that if you want to ask any question to our resource person, don't interrupt her at the time of presentation, but you can write your question in chat box, which will be discussed by our speaker after her presentation. At the same time, I am also requesting everyone to mute yourself when our speaker will start her lecture. Okay? Now, thank you, madam. We start now.
Honorable Principal Dr. Pankaj Devnath sir, respected teachers and beloved students, a very good morning, rather good afternoon to all of you. It's my privilege that the Kuch Bihar College has given me the opportunity to deliver lecture on planning and management of assets for individual. Now my heartfelt thanks goes to every teachers of Department of Commerce, Department of BBA and Department of Economics for inviting me, especially Obhijita, Monimoyda and Tomojit. Now for my lecture, I want to share my screen. Is the screen visible to you?
Yes, madam, you are audible and your screen is visible.
Thank you. So my topic is planning and management of taxes for individuals. There is nothing, this is a very good quotation. There is nothing which hurts more than payment of tax. This is the experience of every individuals. So everyone wants to reduce that burden of tax, but what are the ways to reduce that tax burden? Generally, one can save tax in 3 ways. First one is tax planning through proper tax planning. Second one is through the means of tax avoidance. And the third one is through tax evasion. I like to keep aside the first one for the latter. I'll start my lecture with the tax avoidance and tax evasion. Now, what is tax avoidance? As you see on your screen, tax avoidance is minimizing the incidence of tax by adjusting the affairs in such a manner that although it is within the four corners of the taxation laws, but the advantage is taken by finding out the loopholes in the laws. In short, we can say tax avoidance is that it is the art of dodging tax without breaking the law. That is, cutting off tax burden by taking the advantages of various loopholes of tax system. Though it is not illegal, but it is somehow unethical. Because in tax avoidance, we are taking the advantages of loopholes to reduce the tax. And in the case of tax avoidance, the taxpayer apparently circumvents the law without giving rise to a criminal offense by the use of a scheme arrangement and device often of a complex nature, but where the main purpose is to defer, reduce, and completely avoid the tax payable under the law. Though I am repeating again, though it is not unethical, illegal, but it is an unethical practice, tax avoidance. Now I am coming to tax evasion. This tax evasion is illegal and unethical. All of we know that. This tax evasion, through this tax evasion, unscrupulous citizens evade their tax liability by dishonest means, like concealment of income, inflation of expenses to suppress income, falsification of accounts, conscious violation of rules. And these devices are unethical and have to be condemned. The courts also do not favor such unethical means. Evasion, once proved, not only attracts heavy penalties but may also lead to prosecution. So, this tax evasion for India is a deep-rooted problem nowadays. According to Anurag Singh Thakur, MOS, Ministry of Finance, only 1% of Indian population pays income tax and declares earnings above the non-taxable income. Only 5.78 crores income tax returns were filed during the financial year 2018-19 till February 2020. Out of this, only 1.46 crore individual taxpayers filed returns declaring income above rupees 5 lakh in the financial year 2018-19 till February 2020. And these information I have collected from the Financial Express. So you can see how this tax evasion becomes a deep-rooted problem in a country like India. And such a huge evasion can be possible due to weak surveillance system, rampant corruption in tax department, complicated tax laws and filing mechanism, tax deductions offering loopholes to tax evaders, absence of social security system, high-rated tax slab, and lack of transparency in the government expenditure. So to resolve this problem, individuals need to be aware about the tax planning and tax management. If tax planning and management can be improved, if people will become aware about the tax system, about the importance of paying tax, then the problem may be resolved. Now, we have to know what is tax planning and what is tax management. Obviously, this tax planning is completely different from tax avoidance and tax evasion. Now, tax planning can be defined as an arrangement of one's financial and business affairs by taking legitimately in full benefit of all deductions, exemptions, allowances, and rebates, so that the tax liability reduces to minimum. So through tax planning, we can reduce our tax liability. And tax planning is the analysis of one's financial situation from a tax efficiency point of view, so as to plan one's finances in the most optimized manner. Tax planning is an exercise undertaken to minimize tax liability through the best use of available allowances, deductions, exemptions, And tax planning is a legal way of reducing income tax liabilities. So, tax planning we can say is a double-edged weapon through which we can save tax, through which our savings can be boosted up, and which will ultimately grow our money. Now, there are various fiscal incentives, exemptions, and deductions are there in the Indian tax system, act using of which can reduce the tax burden. If such deductions, exemptions, and incentives are more, tax liability will be lesser. Those deductions can be availed under section 80C to section 80U. Generally, when we think about the tax deductions, individuals can only understand the deductions under chapter 6. Deductions under section 80C and somehow deductions under section 80D. But beside that 80C and 80D, there are numerous sections which can reduce the tax burden. Effective use of those sections is generally the part of tax planning. One may think tax planning and tax avoidance are same, as both are taking the advantages of incentives, deductions, and exemptions. But no, there are huge difference between these two. Tax planning done according to legal requirements defeats the basic intention of legislature behind the statute, would be termed as tax avoidance. And this tax avoidance is done in such a manner that no infringement of taxation laws, and by making full advantages of loopholes to attract least incidence of tax. Earlier, tax avoidance was considered completely legitimate, but at present it may be illegitimate in certain situations. So, from the definition, from the difference between this tax avoidance and tax planning, we can say tax planning is not at all unethical. It is completely the ethical practice and fully legitimate practice. And the Supreme Court verdict regarding the case Maxwell and Company versus CTO in 1985 has said that it is true that the planning may legitimate provided it is within the framework of the law. And using dubious method to avoid the payment of tax is not permissible. And it is the obligation of every citizen to pay taxes honestly. So we can say tax planning is completely legal part, whereas the tax avoidance, though it is legal, but somehow it is unethical. Now I am coming to tax management. Tax management refers to the compliance with the statutory provisions of the law. So paying tax in proper time, whether it is TDS, whether it is advance tax, whether it is self-assessed tax, is the first part of the tax compliance. And the second part is obviously associated with filing returns properly in due time. So while tax planning is optional, tax management is mandatory. It includes maintenance of accounts, filing of return, payment of taxes, deduction of tax at source, and timely payment of advance tax. Poor tax management may lead to levy interest, penalty, or prosecution. In some cases, it may lead to heavy financial loss if proper compliance is not made. If loss of return, for example, if loss of return is not filed in time, it will result in a financial loss because such loss will not be allowed to be carried forward. Now, I am saying this I am focusing on that tax planning and tax management because if students, if you are aware people around you, in your family, in your locality about the importance of tax payment and make them aware about the tax planning and tax compliance, nation will be benefited. And by doing that, you can earn some money by as a consultancy fee also. So you can go through these tax chapters and make your pocket-friendly arrangement by giving some suggestions on tax matters. Now we have to first know how many types of assessee. You all know that there are different types of assessee, including individual, HUF, AOP or BY, local authority, company, or any artificial jurisdictional person. But today our aim is the first type of assessee, that is individual. Now, our target should be to educate and aware individuals. It may be salaried persons, it may be businessmen, rather small businessmen, may be professionals, but at the onset, we have to try to focus only on small businessmen because they are very much ignorant about the tax matters. Why I'll be saying this, I'll explain later on with some of my studies. Now, our first task is to know the various problems faced by individuals. Unless we are not aware of their problems, it will be difficult to address those problems. First, in this slide, you can see what problems salaried individuals are facing. It's a very common practice that they are taking the help of tax consultant for their tax matter. But it is not at all required. If they understand all the provisions, they can compute tax for themselves and they can plan their savings and also plan their tax matter accordingly. Besides 80C and 80D, there are lots of provisions. I have already said that for tax savings. They should be aware of those provisions. From the assessment year 2021-22, a change was there in the tax system. Now there are two tax regimes are open for all. One is old one and the second one is new one. In old regime, you can get deductions under all provisions, but under new regime, 70% deductions are omitted. And the system becomes easier for the assessee. Now, choosing proper tax regime is another hard task. Which regime will be suitable for any taxpayer? He should know that in due time. Again, paying tax in due time is another problem. Generally, on the basis of salary statement, advance tax are deducted. But this advance tax generally are suggested by the taxpayer himself. Sometimes self-assessment tax is necessary. Payment of advance tax and self-assessment tax need to be submitted in due date. It is very much necessary to know the cut-off dates for submitting, for paying tax, and also for filing return. Nowadays, it is very much easier, and almost all the fields can be filled in autofill when you file your return. But we have an inherent tendency to go to the tax consultant for return file. It is not at all required. Now, small businessmen and professionals have faced the same problem as salaried person, but they have faced an unique problem apart from other problems that I have discussed at the time of salaried personnel. Civil contractors, retail traders, wholesale traders, and other businessmen, except those who are not engaged in business in the nature of brokerage or commission, and plying and hiring or leasing goods and carriages, having gross receipt below 2 crore per annum, can presume their taxable income under section 44A. And professionals, including engineers, lawyers, architects, accountants, doctors, interior designers, and others, have gross receipts not exceeding rupees 50 lakh per annum, can presume their income under section 44A. For that, audit of accounts are not required, but the problem is they are not so much aware about the presumptive taxation system. Details of presumptive taxation system are discussed. I will discuss that system in my next slide. So this is the system of presumptive taxation schemes. Those schemes are applicable to individuals, to HUF, to association of persons, partnership, and company. But our concern is only individual, because we are dealing with the tax planning and management of individuals. Obviously, the business form is sole proprietorship form and individual professionals. Since its inception, since the inception of presumptive taxation in 1994-95, it has gone through a long journey with several changes. Now, there is a question that may strike your mind, that why I am taking the assessment year 2011 and 12 as the base year. Because from this year, section 44AD reconstructed, and all businessmen are encompassed in this section. Before that, different sections were there for civil contractors, for retail traders, and for businessmen plying, hiring, and leasing of goods and carriages. From the assessment year 2014 and 15, plying, hiring, and leasing of goods and carriages under section 44AE are omitted. And professionals are included in this presumptive taxation scheme from the assessment year 2017 and 18. This is an extract from one of my study. That is, the title of the paper is Presumptive Taxation for Professionals, Systems and Perception, which is published in International Journal of Research and Analytical Reviews. From this table, you can understand that respondents who are aware about the presumptive taxes are in favor of presumptive taxes. But for the tax related matter, though to them it seems very easier system, but they want to go to tax consultant for compliance and other tax related matter. They cannot rely themselves for payment of taxes and for other compliance matter. From this table you can find this. I'm not going in details to that questionnaire or the mean score or the GAD value. In this table, this is also the extract from the same publication. Here you can find that the sample respondents are not aware about the presumptive taxes. They first given the information regarding the presumptive taxes, and after knowing the system, they also perceived this system as easy, but they inclined to tax or consultants for dealing with their tax matters as well as for the compliance of their tax, for the compliance related to their tax. I'm not again going in details in all the questions or in all the statements. You can see the statements by yourself. Now, this similar result, as I have said in those two extracts, were observed when we perform a same type of study on contractors as well as on retail traders. With the passage of time, their intention to rely on tax consultants not yet curbed. Now we are coming closer to tax planning part, and for that we have to know the tax rates or the tax rate that are prevailed nowadays for individuals. From assessment year, I have already said 2021-21, there has been a complete change in the tax rates. Tax rates prevailed in earlier years are followed as old tax regime. For convenience and better tax compliance, a new tax regime has also been introduced. Now we are discussing changes in tax rates. In this table, you can find the tax rates for the individuals who are below 60. You all know these tax rates. And this table shows you the tax slab between the for the individuals who is in between the age from 60 to 80, that is who are senior citizens. And this is the tax rates under old tax regime for senior citizen. You can get it anywhere. Now, this is the old tax regime, tax rates under old tax regime for super senior citizen. That is the senior citizen above 80 years. And you can find this slab also when you search through the net or any books. Now I am coming to the new tax regime. Look, here the slabs are broken or parted in seven ceiling. That is for up to rupees 2.5 lakh. The tax rate is nil. From 2.5 to 5%, from 5 lakh to 7.5 lakh, 5 lakh 10%, from 7.5 lakh to rupees 10 lakh 15%, 10 lakh to 12.50, 20%, 12.5 to 15 lakh, 25%, and above 15 lakh, the tax rate is 30%. So there is a there are 7 slabs in the new tax regime, but there is a difference between these two regimes. All the deductions through which we can plan our tax are all available under the old tax regime. But in that new tax regime, almost 70% deductions were curtailed. Deductions like leave travel allowances, house rent allowances, conveyance allowances, relocation allowances, children education allowances, standard deduction, professional tax, all are curtailed in this new tax regime. Interest on loan deduction, interest on house building loan, interest on education loan, that is all the deduction under chapter 6A, that is section 80C, 80D, 80E, and all other sections are not entertained in this new tax regime. Only deductions that are allowed under new tax regime are the transport allowance for specially able person, conveyance allowance for expenditure incurred for traveling to work, investment in notified pension scheme under section 80 CCD, subsection 2, deduction for employment of new employees under section 80 JJAA, depreciation under section 32 of the Income Tax Act, except additional depreciation. Any allowance for traveling for employment or on transfer are allowed under this tax regime. Which deductions? We will discuss those deductions that are only allowed for individuals. Now, we can say that this new tax regime is optional. Why? Because taxpayer has an option to choose either to pay income tax at lower rates as per new tax regime, on the condition that they forego certain permissible exemptions and deductions available under income tax, or to continue to pay taxes under the existing tax rates. The assessee can avail rebate exemptions by staying in the old regime and paying tax at the existing higher rate of return. Now, as a tax planner, you have to know which tax regime will be selected and what is the time frame for selection of the tax regime. You can select the tax regime only at once in a year. For salaried person, for deducting advance tax or self-assessment tax, or for any income which attracting TDS, an employee can opt to choose for the new tax regime and intimate their employer at the beginning of the financial year 2020 or 2021. And employees can change the option of selecting the tax regime every year. However, if new tax regime is opted at the beginning of the year, it cannot be changed any time during the year for tax purposes. However, the option can be changed at the time of filing the income tax return. That is, you have an option to change the mode of tax regime at the time when you filing your return. Now, for the income from business and profession, the option to choose between the tax regime is available only once for a particular business. That is, you have to choose which tax regime you will follow at the beginning of the year. Before that, I will discuss this. I will discuss how this tax regime will be beneficial for a person. I like to say that the new tax regime can largely benefit middle class taxpayers who have a taxable income up to rupees 15 lakh. Old regime is a better option for higher income earners. The new income tax regime is beneficial for people who make low investments. As a new regime offers 7 lower tax slabs, anyone paying taxes without claiming tax deductions can benefit from pay a lower rate of tax under the new tax regime. For instance, you can say assessee having total income before deduction up to rupees 12 lakh will have higher tax liability under the old system if they have investments less than 1.91 lakh. I will calculate it from several examples. I have already calculated it from several examples, and therefore we can say that if you invest less in the tax saving schemes, then go for opting new tax regime. If you have already in place a financial, if you are already in a financial planning for wealth creation by making investment in tax saving instruments, mediclaim and life insurance, making payments of children tuition fees, payment of EMIs on education loan, buying a house with a home loan, and so on, the old regime helps you with a higher tax deduction and lower tax outflow. Now, with an example, I will try to make it clear. There is an example. Mr. Rahul has a salary income of rupees 10 lakh. His total investment under Section 80C is rupees 1.7 lakh under LCL, LSS, PF, LIC premium, and principal installment of home loan. Further, he pays medical insurance for himself and his wife, rupees 28,000. If he opts for the old tax regime, then he can claim the above deductions. However, if he wishes to go for a new tax regime, then those deductions will not be available to him. He has paid home loan interest of rupees 75,000 in the financial year 2020-2021. Now, first we have to find the tax outflow in both the regimes. In this slide, you can see the computation of total taxable income under old tax regime and also under the new tax regime. His gross income is rupees 10 lakh, and under old tax regime, he can get deduction under Section 80C for 1,50,000, under Section 80D 25,000, Section 24 subsection B for interest on loan taken for building his own house, 75,000. So after deducting all the deductions, taxable income is 7,50,000. Whereas under old new tax regime, the taxable income is 1 lakh because no deduction is available under new tax regime, and I will discuss this section 80C, 80D all afterwards in details. Now, under tax slab, old tax slab, tax for 2.5 to 5 lakh at the rate of 5% is 12,500, and in the next slab, that is from 5 lakh to 10 lakh, it is 50,000. So total income tax is 62,500, on which 4% cess has to be paid, that is 2,500. Therefore, total tax outgo is 65,000. And in new tax regime, first slab, that is 0 to 5 lakh nil, 2.5 to 5 lakh at the rate of 5%, 12,500. 5 to 7.5 lakh at the rate of 10%, 25,000. 7.5 lakh to 10 lakh at the rate of 15%, 37,500. So his total income tax under new tax regime is 75,000. And cess at the rate 4% is 3,000. Total tax outgo will be 78,000. So from these two, we can say old one will be beneficial for him, as he has a tax savings plan and also wealth building plan with himself. Now, this is the rate of surcharge for the assessment year 2021-2022 for 50,000 for 50 lakh to 1 crore. Sorry, 5 lakh to 1 crore, 10%. More than 1 crore, 15%. More than 2 crore to 5 crore, 25%. More than 5 to 5 crore to 10 crore, or more than 5 crore, it is 37%. So this is the rate of surcharge. Now, I'm coming to that slide. This slide is this slide will express the rationale behind introduction of this new tax scheme. The area of fiscal incentives, if wisely and legally used, can make substantial differences in tax actually paid and tax calculated at marginal rates on pre-taxed profits. The high magnitude of tax revenues foregone due to those tax deductions in the past few years due to a vast array of fiscal incentives in form of deduction, exemptions, and incentives. Different committee on taxation has been formed to reduce that revenue foregone due to a long range of fiscal incentives available to individuals as well as to corporates as well as to business. Here is the figure of revenue foregone for some year, that is from 2005 to 2018. To cut the amount of revenue foregone due to various deductions, exemptions, and incentives, new tax regime has been introduced. You can see there is a long skyscrapers of revenue foregone up to the year 2014 and 15. And after 2014 and 15, there is the tax revenue, the skyscraper of tax revenue becomes slightly lower. Now, why this is certainly becomes lower? Because this is lower because from this year, that is from 2015 to 15-16, a new system of methodology for calculating the revenue foregone has been introduced. And from this year, GST has been introduced as a method of indirect tax, and the revenue foregone under GST as is minimum as compared to other direct taxes. The height of the skyscraper becomes lower. Now again I will now coming to that slide. This I have shown in my earlier slide the revenue foregone in different years. These skyscrapers include corporate tax, the skyscrapers include indirect tax, the skyscrapers include individual tax also. And for the assessment year 2016 and 2017, the different tax items that are included in the revenue foregone, that is revenue foregone due to corporate tax, customs duty, excise duty, and personal tax are given here. Look at the right hand side column, which is the column for personal tax. And this column is quite high as compared to the other column. So we can say that the individual revenue foregone due to individual taxes is quite distinct, and to curb that revenue foregone due to different taxes, there is a curve in the different form of deductions. To reduce the revenue foregone, new tax regime has been introduced where taxpayers have to pay taxes on the gross salary or gross profit, and no deduction is allowed under this tax regime except certain deductions. And this section has been introduced to curb the amount of revenue foregone due to a vast array of fiscal incentives allowed to different types of assessments. Under old regime, taxpayers can enjoy a large number of deductions, exemptions. Individuals can avail deductions under various sections from 80C to 80U. Now we'll go in details of those sections. You can see in this slide, you can save, individual can save tax under section 80C. Individual can save tax under section 80CCC. Individual can save tax under section 80CCD, under section 80D, 80DD, 80DDB, under section 80EE, under section 80EEA, under section 80EEB, 80G, 80GG, 80QQB, 80RRB, 80TTA, 80TTB, and also under section 80U. First, I am coming to section 80C. This is a very known section to everyone, because all of us can claim deduction under section 80C, where we have to claim deduction for the payment of LIC premium, for payment towards different annuity scheme, for payment towards PPF, GPF, RPF, for payment towards NSC 8th issue or 9th issue, for contribution towards ULIP of UTI, LIC mutual fund, for payment of pension fund set up by Mutual Fund Retirement Benefits Plan of UTI, Reliance Retirement Fund, and also the subscription to home loan account of National Housing Bank, also for the subscription to public deposit scheme of HUDCO and Housing Board, some paid as tuition fees to school, college and university going children, repayment of housing loan, amount invested in approved debenture or equity shares of public company, term deposit for 5 years, subscription to notified bonds of NABARD, amount deposited in senior citizen savings scheme, amount deposited in 5 years time deposit scheme of post office, amount contributed to NPS, and the amount of deduction under section 80C in aggregated way of section 80CCC and 80CCD subsection 1 cannot exceed rupees 1,50,000. That is the sum of deduction under section 80C plus 80CCC plus 80CCD subsection 1 cannot exceed rupees 1,50,000. Now I am coming to section 80CCC. Amount deposited in annuity plan of LIC for receiving pension by the SEC, and also the deduction for the same is claimed under section 80C when no deduction can be claimed under section 80CCC. An amount of deduction, as I have said earlier, that it is the aggregate of section 80C, 80CCC and 80CCD subsection 1 cannot exceed rupees 1,50,000. And now the deduction under section 80CCD. Under 80CCD subsection 1, assesses contribution toward NPS. This NPS is the new pension scheme, a national pension scheme which includes new pension scheme and also the Atal pension scheme. And this assesses contribution towards NPS not exceeding 10% of the salary is deductible under section 80CCD subsection 1. And under section 80CCD subsection 2, employer's contribution. Look, here is a difference. First one is the employee's contribution or assessor's contribution. Second one is the employer's contribution towards NPS not exceeding 10% of the salary is deductible under section 80CCD subsection 2 or 14% if employer is central government. And this deduction is available from the assessment year 2020-2021 in the new tax regime. And the additional contribution of SEC towards NPS under section 80CCD subsection 1B is there, and under section 80CCD subsection 1B, additional deduction of rupees 50,000 can be claimed. So we can say the total amount of deduction under section 80C, 80CCC and 80CCD subsection 1 cannot exceed 1,50,000. In addition to that, we can claim a deduction under section 80CCD subsection 1B of rupees 50,000. Now, how can we claim those deductions? There is an example. X, who is covered by NPS, gets a salary of rupees 9 lakh per annum. He annually contributes 10% towards NPS and rupees 1,24,000 towards PPA or LIP since 2014. Now, regarding tax planning, what we can do? X has not made any additional investment over and above minimum requirement of 10% contribution. towards NPS, but he can claim deduction of rupees 50,000 under section 80 CCT subsection 1B. As it is a normal conception that only we can claim a deduction 1,50,000 under section 80C, 80CCC, 80CCD subsection 1. It is a normal practice, but no. First we have to deduct the deduction. First we have to go for the deduction under section 80CCD subsection 1B, because under this section we can claim additional deduction of rupees 50,000, and after claiming that, for that you need not to invest any extra amount. Your contribution towards NPS is 10% of your salary, so this is 90,000. So you can easily claim rupees 50,000 under section CCD subsection 1B. So for rest of the amount, that is for rupees 40,000, you can claim deduction under section 80 CCD subsection 1. So your 90,000 will be over. Now you can claim deduction under section 80C, 80CC, 80CCD subsection 1. The total amount of deduction should not exceed rupees 1,50,000. You have already claimed rupees 40,000 under section 80 CCD subsection 1. So you can claim more deduction of rupees 1,10,000 under section 80C, because it is given that your the excess contribution towards PPF or LIP is 1,24,000. So from that, 1,10,000 is allowed for deduction. So we can get a deduction for total amount 2 lakh, of which 50,000 is under 80 CCD subsection 1B, 40,000 is under section CCD subsection 1, and 1,10,000 is under section 80C. So in this way, you can broaden your tax deduction. You can make an assessment which will allow you to take the benefit of deduction in a full. Now I am coming to the deduction under section 80D. It is also a very known section, because this is a section for making payment towards health insurance or Mediclaim for the family members or for the own. Now this family includes spouse, parents and children, and payment should not be made in cash mode. If cash payment is made, no deduction is allowed under this section. So you can advise everyone to make payment for the Mediclaim in check or in online mode. No cash payment should be allowed for deduction under section 80D. And the maximum amount of deduction under section 80D is rupees 25,000. Now, if policy is taken on super senior citizen, then you can earn an additional deduction of rupees 25,000. So your total deduction will be 50,000 under section 80D. If you have a super senior citizen members in your family. Now the deduction under section 80DD. Under section 80DD, payments towards medical treatment of dependent person with disability are allowed as deduction, or payments towards any scheme funded by LIC or other insurance company or the administrator are allowed under section 80D. Now the amount of deduction under section 80DD is rupees 75,000. So if disability is 80% or more, fixed deduction of rupees 1,25,000 can be availed. Abhijit, am I going long?
You just conclude.
There are certain there are certain provisions also. May I get 15 minutes more?
Okay, madam. You may proceed.
Okay.
Thank you. Okay, so amount of deduction under section 80DD is rupees 75,000, and if the disability is 80% or more, your deduction will be fixed in the form of 1,25,000. Now coming to section 80E, and deduction in respect of payment of interest on loan for higher studies for his own and also for the spouse or child. And you can get deduction for a period of 7 years on the entire amount paid by the interest on loan amount. Now the deduction under section 80EE, and under section 80EE, you can get a deduction if the payment does not exceed this is the section for which we can get deduction for interest in house building loan, and the loan was taken for the acquisition of the house property, the value of which does not, the loan amount does not exceed 35 lakh, and the value of the residential house property should not exceed 50 lakh. And SSC does not possess any residential house property on that day of sanction of loan. So deduction is allowed on interest payment on loan up to a maximum of rupees 50,000. Now section 80EA. Under this section, deduction in respect of payment of interest on loan for residential house property taken after 1st April 2019 is come under this section, and the loan was taken for the acquisition of house property after 1st April 2019, and the stamp duty value of residential house property should not exceed 45 lakh. So SSC does not possess any residential house property on the date of sanction of loan. So the amount of deduction will be 1,50,000. The maximum amount of deduction will be rupees 1,50,000 if 1,50,000 of loan under section 80EA if he has no deduction under section 80EE. Now the deduction under section 80EEB, and this section was inserted in the from the assessment year 2020-2021. That is, this is a new section. Deduction in respect of payment of interest on loan for purchasing of electric vehicle taken after 1st April 2019 is allowed under this section. And this vehicle was powered exclusively by the electric motor whose traction energy is supplied exclusively by traction of battery fitted in the vehicle. That is, for example, you can think about our Toto. Hybrid car is not allowed under this section. And the maximum amount of deduction which is allowed is the interest payment on loan up to a maximum amount of rupees 1,50,000. That is, only interest on loan is deductible under section 80EE. And under section 80G, all of you know that we can, if we make any charity, if we make any donations, for that we can claim deductions under section 80G. Donation can be made in cash, check or online, but if the donation amount is more than 2,000 from the assessment year 2018 and 19, you cannot claim any deduction under section 80G. For those amount, you have to make check payment or online payment. The amount of deduction is 100% or 50% as the case may be. You can see here are the different scheme for deduction under section 80G. I am not going in details of that because in any book you can find it. This is also some other provisions of section 80G. Also, I am not going in details of that. And we are coming now towards deduction under section 80GG. Self-employed individual or salaried individual who does not receive any house rent allowance can avail deduction under section 80GG. Individual paying rent for residential accommodation can avail deduction, and the taxpayer or his or her spouse, minor children cannot own any residential accommodation for availing deduction under section 80GG. And the maximum amount of deduction will be the least of the three, that is rupees 5,000, 25% of the total income, and the excess of actual rent paid over 10% of the total taxable income after adjusting all deductions under section 80C to 80U except section 80GG. So this is the deduction for house rent allowance. Now I am coming to the deduction for royalty under section 80QQB. This section is very much important for salaried persons like us, that is salaried persons like teachers, like professors, because like professors, and royalty on the books given to both author and joint author are allowed under this section. For royalty income, book should be a reference book and it should be an original writing of the author. Textbooks, journals, magazines, brochures are not considered such book for this purpose. And the royalty accrue in India as well as in abroad can be allowed as deduction under section 80QQB, and the amount of royalty does not exceed 15% of the total value of books sold during the previous year. And the taxpayer shall have to obtain a certificate in form number 10 CCD from the person responsible for paying the royalty. And the amount of deduction will be the least of the two, that is rupees 3 lakh or the income from the royalty, which is the least amount. And under section 80 RRB, royalty on patent given to both owner and co-owner are under this deduction, and this patent should be registered under the Patent Act 2003. It includes any royalty amount from working or use of patent. It includes lump sum amount for the transfer of all rights. It does not include any amount earned by the sale of patented product. The assessee shall have to furnish electronically a certificate in form number 10 CC, which is duly signed by the prescribed authority. Prescribed authority is defined in the Patent Act. And the maximum amount of deduction will be least of rupees 3 lakhs and the total amount of royalty. So this is section 80 RRB. Now I am coming to section 80 TTA. This is a very common section, and deduction is available for interest on deposits in a savings account with a banking company and cooperative society engaged in banking business or a post office are coming under the purview of section 80 TTA. Here deposits do not include the term deposit, and the senior citizen cannot avail deduction under this section. The maximum amount of deduction will be rupees 10,000. Now the deduction under section TTB, this is applicable from the assessment year 2019-20, and this deduction is available for the interest on deposit on a savings bank account with a banking company, cooperative society engaged in banking business or a post office for the senior citizens. And deposits do not include term deposit, and also the maximum amount of deduction is 50,000. Here the difference lies between section 80 TTA and TTP. Under section 80 TTA, deduction is 10,000, and under section 80 TTP, deduction is 50,000. And under section 80U, an assessee can avail deduction if that assessee suffering with a 40% or more disability. Disability includes blindness, low vision, leprosy, hearing impairment, locomotive disability, mental retardation, mental illness, autism, cerebral palsy, and multiple disabilities. Disability should be certified by the approved medical authority of the government hospital and the health centers. And for under this section, a fixed deduction can be available for rupees 75,000 if the disability is 80% or more. Then the fixed deduction for rupees 1,25,000 is allowed for the taxpayer. Now, if there is a common mistakes for filing return which results in tax evasions. I am quoting some common mistakes over here. There is a common practice that not showing royalty or patent unless it exceeds rupees 3 lakhs. We all here is a common practice of thinking that, oh, my royalty income or patent income not exceeds rupees 3 lakh. Why we will show that in my return? But this is a wrong practice. You have to show it in your return, and afterwards you have to claim deduction from that. Same practice is for the interest on saving deposits. Unless our saving deposits, interest on saving deposits cross the amount of rupees 10,000, we cannot show it. It's a common practice not to show it in our return. But it's a wrong practice. It leads to the tax evasion unknowingly. It leads to the tax evasion. We have to show it, and afterwards we have to claim deduction of rupees 10,000 from that. And same practice prevails for the saving deposits in case of senior citizen. And it's a very common mistake done by the senior citizen. They never show the deposits, interest on deposits in their return. And I have made a survey on the second portion, that is the deduction under section 80 TTA for 250, around 250 respondents. Of them, surprisingly 171 respondents are not have not shown any interest on fixed deposit in their returns, which leads to tax evasion unknowingly. So please aware everyone to show all this income in your return, in their return. So these are the tax saving scheme. I am not repeating it again. Now I'm coming to the tax compliance part. It is also an important part of tax management. Unless we know the proper date for deducting advance tax and how much portion we have to deduct as advance tax, there is a penal action that we have to bear. So we have to deduct 15% of advance tax before 15th June, 45% of the advance tax before September 15, 75% of the advance tax before December 15, and the rest of the total amount, that is 100% advance tax, before 15th March of the previous year. Formerly, we have a practice of deducting total tax at the assess your tax and you have to deduct advance tax in a right proportion within the right time schedule. And if the assessee is filing his return under section 4080 subsection 1 and 44 ADA subsection 1, that is under presumptive taxation, they have to pay 100% of advance tax within 15th of March. Now here is the return for different return form. Generally we have to file the return under section through the return form ITR 1, and the persons who are giving their tax under presumptive tax can file their return through the form ITR 4. So choosing proper form and submit your return within the stipulated time is another important task for every taxpayer. And when we submit ITR 1, there are some important points. You have the asset, you have to, ITR 1 is not applicable when a person has assets outside India, has signing authority in any account located outside India, has income from any source outside India, has income to be apportioned in accordance with the provisions of section 5A, or likewise there are some provisions, you may note this. And when you submit the return under section through ITR 4, the application filing of return through ITR 4 is not applicable in case of a person who owns more than one house property, who has brought forward loss or carry forward loss under the head of business income, who has to audit their accounts. They cannot file their return through ITR 4. Now, mode of submission. How can we submit this return? We have to submit those returns electronically. When accounts are required to be audited under section 44AB, you have to submit your form to electronically with digital signature, but return submitted by an individual who has born before April 2, 1939 and submit their return through ITR 1 or ITR 4, he has to submit his return through electronic mode, or he may submit his return in paper format. In that case, he has to mail his return to the Bangalore head office. Now, the time for filing return. Generally, when the assessee is required to furnish a report in form number 3CEB under section 92E, he has the date of submission of return will be November 30. Where the assessee is a company, the date of submission of return is September 30, and where the assessee is a person other than company, not having international or specified domestic transactions, where the accounts of the assessee are required to be audited, he has to file his return within September 30, and where the assessee is a working partner in a firm, accounts are required to be audited under any law, also needs to submit his return within September 30. But for others, the date of submission of return is July 31. That is for individual. In our case, the date of submission of return will be July 31. So at the end, we can say, if proper awareness about the tax planning and management is there, it can reduce the tendency of evading tax knowingly or unknowingly. Presently, huge numbers of field are under the auto fill option. So it becomes very much easier to file the return. So students, you can help people to file your return. You can go through the income tax site, and it is a very easy task to file the return nowadays. So you can help others to file return. And ITR 1 fill up becomes really Sahaj nowadays. Its name is Sahaj, and now it becomes really Sahaj. Proper awareness is there. Return filing becomes Sahaj to everyone, as the name suggests. And filing up of ITR 4, also very easy task. The name of the ITR 4 is Sugam. If proper awareness regarding presumptive taxation is built up, filing up of return will become really Sugam for taxpayers. And filing of return will become really Sahaj and Sugam for every students if they are going through the website of the income tax and have a look on the filing of return. So this is for me. Thank you for patient sharing, and the time is exceeding almost 30 minutes. Sorry for that. Thank you very much. If you have any query, you can ask me.
Thank you, madam, for your excellent presentation. You have explained in detail almost all areas of tax planning and tax management. You have explained in detail the definition of tax planning, tax management, the difference between tax evasion and tax avoidance, and you have also discussed the two tax regimes which are available for an individual, and the deductions under Section 80 which are available for an individual, and the date of filing return. Everything you have discussed clearly. So again, thank you, madam. And now it is the time. It is the time for question and answer session. Now, students, you have any question, you may ask you, madam. I think there is no question in chat box, so you may ask, madam. You please unmute yourself and ask madam if you have any question. Students, have you any question? Is there anybody who have any question? You may ask.
I think they don't have any question. The discussion is self-explanatory.
Okay. So today's session has come to an end. Now I am requesting Professor Shankar Saha, coordinator of BBA department, to conclude the session and to give vote of thanks.
Good afternoon, everyone. I am honored and lucky to have the opportunity to give a vote of thanks on this special lecture. I particularly like Professor Dr. Gangotri Ghosh, Department of Commerce, University of North Bengal, teaches where she mentioned the need for tax planning under personal income tax in this special lecture session. The way in which she explained these subjects was extraordinary. I would like to thank all those organizing teams, Institute of Department of Commerce, Institute of Department of Commerce, Professor Ujit Rai, and senior faculty or senior professor of Cooch Behar College, Department of Commerce, and Secretary of Teachers Council, Professor Munimoy Chakraborty, Dr. Samojit Rai,
Professor Sumon Sarkar, and HOD of Economics, Professor Sushman Mondol, and Professor Firuz Hasan, and Professor Subundu Chakraborty. I must not forget to thank our beloved students of Department of Commerce, BBA and Economics who contributed to organizing these special lectures until the last minutes. Finally, I again want to thank the principals, the respected chairman of the lecture session of Kujviar College. I would like to thank you again for making this session a success. Thank you.
Thank you, Professor Shankar Shah. So now it has come to an end. Now, students, you may leave now. And Abhijit.
Thank you, Gangotri.
চলে গেছে নাকি তাহলে
থ্যাংক ইউ অভিজিৎ আমি মিউট করেছিলাম আপনি করতে ভুলে গেছেন বলছে don't know whether it is fruitful to students or not because they have no question at all.
No, it is fruitful for all of them. Actually, it is applicable not only for students but also for everybody. Everybody should know tax planning. In order to minimize tax burden.
কভারেজটা খুব ভালো ছিল, সব অ্যাক্টিভিটি কভার করা হয়েছে।
যেহেতু স্টুডেন্টদের জন্য সেটা চেষ্টা করেছিলাম আর কি কভার করে।
হ্যাঁ মোটামুটি একদম পুরোটা কভার করেছে।
হ্যাঁ, কম্প্রিহেন্সিভ অ্যানালাইসিস হয়েছে, ঠিক আছে গঙ্গোত্রী, আমাদেরও তো কাজে লাগে। নিউরিজমটার সাথে আমি তো অতটা করতে পারি না, বুঝতে পারি না সেটা বেটার। আজকে ভালো করে আরো কনসেপ্ট ক্লিয়ার হলো। থ্যাংক ইউ।
থ্যাংক ইউ অভিজিৎ। আমি কি করতে পারি এখন?
হ্যাঁ ঠিক আছে।
হ্যাঁ,
আমাদের কালকে আরেকটা সেশন আছে সেম টাইমে।
ওকে